The IRS changed the rules, and nobody told you if you earn tips, work overtime, bought a car, or are over 65, you may be owed thousands. A federal law, signed July 2025, created 6 deductions the IRS will not apply for you. They live on a brand new form called Schedule 1A. Skip it and you lose them. Here are all 6, starting with the one hitting paychecks first. Number 1 on our list is a major change for service workers, the federal deduction for tip income. If you work as a server, bartender, or in another qualifying tipped occupation, you can now deduct up to $25,000 of your reported tips per year directly from your taxable income. But here is the catch. You must have documented these tips properly. Only tips reported to your employer and included on your W-2 in Box 7 or self-reported on Form 4-137 will qualify for this tax break. There are also income limits to keep in mind. This deduction begins to phase out once your modified adjusted gross income exceeds $150,000 for single filers or $300,000 for married couples filing jointly. Most importantly, the government will not calculate this for you. You have to actively claim the deduction by attaching the new Schedule 1A to your standard tax return. Taxpayers who keep clean records and claim these new breaks themselves are securing much larger refunds this filing season. If you earn tips this year, make sure you take action on your return so you do not leave your money behind. In second place, hourly employees, shift workers, nurses, factory staff, and tradespeople who earn overtime pay under the Fair Labor Standards Act get a major break. This rule allows you to deduct up to $12,500 of your overtime compensation from your taxable income or up to $25,000 if you are married and filing jointly. The math here is specific. You can only deduct the extra half portion of your time and a half overtime pay. If you make $20 an hour normally and $30 during overtime, only that extra $10 per hour qualifies. There are also clear limits and rules you need to know. First, this deduction phases out once your modified adjusted gross income climbs past $150,000 for single taxpayers or $300,000 for married couples. If you are married, you must file a joint return to claim this benefit at all. Also, overtime paid only because of a state law or a specific union contract does not qualify. It has to be standard federal overtime. Just like before, the IRS will not calculate this for you automatically. You must claim this deduction yourself by filing Schedule 1A with your return. Taxpayers who keep track of their pay stubs and actively claim this overtime break are the ones securing larger refunds. Third on our list is a massive break if you recently financed a new set of wheels. If you took out a loan to buy a brand new vehicle for personal use, you can now deduct up to $10,000 of your auto loan interest per year directly from your taxable income. But here is the catch. Your vehicle must have its final assembly right here in the United States. If your car was manufactured overseas, you cannot claim this break. Also, leased vehicles are completely excluded from this deduction. It only applies to financed purchases. There are strict income limits too. This deduction begins to phase out once your modified adjusted gross income exceeds $100,000 for single filers or $200,000 for married couples filing jointly. The government will not calculate this for you. Just like the other new tax breaks, you must actively claim this interest deduction yourself by filling out Section 4 of the new Schedule 1A and attaching it to your return. People who keep their loan paperwork handy and file this form themselves are walking away with much larger refunds this filing season. Number 4 on our list is a massive boost for anyone age 65 or older. Nobody told you this, so I will. If you or your spouse hit this age milestone, these new rules allow you to claim an extra $6,000 per person. For a married couple filing jointly, that is an extra $12,000. The best part is this does not replace your existing benefits. It sits directly on top of the senior standard deduction you already get, shielding much more of your money from taxes. Of course, there is a catch. This extra deduction begins to phase out once your income crosses $75,000 for single filers or $150,000 if you are married. Just remember that the IRS is not going to calculate this for you automatically. If you want this money, you have to actively claim it yourself using Section 5 on Schedule 1A. Keep your documents ready, file the form, and do not leave your money on the table. Number 5 on our list is a major adjustment that directly impacts homeowners and families paying state and local taxes. Nobody told you this, but the old $10,000 deduction limit, popularly known as the SALT cap, has quadrupled to $40,000. This is one of the single biggest numerical jumps on our list, giving you far more room to write off your state income, sales, and property taxes directly on your federal return. It is designed to provide massive relief to middle-class families in higher tax communities. But here is the catch. If your household modified adjusted gross income exceeds $500,000, this expanded benefit begins to phase down. Just like the other changes, the IRS is not going to calculate this higher cap for you automatically. You have to actively claim it yourself by filing Schedule 1A alongside your standard return. Homeowners who keep clean records of their local tax payments and file this form themselves are the ones securing much larger refunds this filing season. Number 6 on our list is a clean, straightforward update that directly impacts working families. The expansion of the child tax credit. Nobody told you this, so I will. The credit has increased from $2,000 to $2,200 per qualifying dependent child. While a $200 increase might seem small at first, it adds up quickly for families with multiple children, keeping more of your hard-earned money in your pocket. This boost is specifically for parents with qualifying dependent children who live with them for more than half the tax year. But here is the catch. There are income phase-out limits you must meet, and the refundable portion of the credit remains capped at $1,500. Just like with the other tax changes on our list, the government will not automatically apply these updated numbers to your tax return if you fail to claim them. You have to take action and file correctly to get the maximum relief. Taxpayers who stay on top of these rules and claim these credits themselves are securing much larger refunds. Keep in mind that this video is strictly for educational purposes and does not constitute personalized tax advice, so you should always verify your eligibility with a certified professional before filing to make sure you never miss out on major financial updates and tax saving tips. Subscribe to our channel today. Across all 6 deductions, the pattern is clear. The burden of saving money is entirely on you. The IRS will not automatically apply these updates, but those who take action claim the biggest refunds. Remember, this is educational, not professional tax advice. Subscribe for more insights.